Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video we're going to be going over FAR Area 1D, and this is an application topic. Calculate the basic earnings per share and diluted earnings per share considering the impact of stock options, preferred stock, convertible preferred stock, and or convertible debt. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, that is one of our main strategies, is diving straight into the questions instead of watching lectures or reading textbooks. Again, diving straight into the questions because that's what you're going to be doing on test day, so why not practice it? If you want to learn more, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, things like studying in the morning, again, going into the questions first, doing mini sessions throughout the day, and things like that. You'll learn a lot, so make sure you go check out that webinar. Also, just letting you know, we will only be going over 6 questions in today's video, but just remember that SuperfastCPA members will have access to the full 12-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperfastCPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1, and as we're diving into these questions, something that you always want to remember, this is part of one of our strategies, is always go to the last question or to the bottom of the question for whatever question you're looking at, because that usually is the real question. That's really what you're looking for in all this information. So let's read this first. What is Midnight Corp's basic earnings per share for the year? Okay, so we know that we need to figure out the basic earnings per share based off of this information, so now we can read it with that in mind. At the beginning of the year, Midnight Corp had 1 million shares of common stock outstanding. On April 1st, the company issued an additional 500,000 shares. On October 1st, the company issued another 200,000 shares. On December 1st, the company repurchased 120,000 shares of treasury stock. Midnight Corp reported a net income of $3,600,000 for the year. So again, with all that information, we need to figure out the basic earnings per share for the year. Now, if you have an idea of how this works, that's great. Go ahead and pause the video and do the calculation yourself. If you don't know how to calculate basic earnings per share, that's okay. We're going to dive straight into the answer if that's the case and learn how to do this and how it works. All right, here we are at the answer. The answer is $2.54, and that was answer D. So that's the answer for the EPS that was calculated. Let's go through how to calculate that. So just a reminder, the basic EPS calculation is net income less preferred dividends, all that divided by the weighted average number of common shares outstanding. So that is the formula. That's something you're definitely going to need to remember. Let's go through these steps. Step 1, we have to calculate the weighted average number of shares outstanding. This is something that is pretty simple if you know and remember how to do it. So let's walk through it and kind of think through this, how it works. So this is one way you can calculate it. I'll show you in the next question another way you can calculate the weighted average. So you start with the shares that they had at the beginning of the year. So 1 million shares. They had those 1 million shares the whole year. So we just count that 12 out of 12 months. The shares issued on April 1st, that was 500,000 shares. And since it started in April, January, February, and March, those shares were not there. So those shares were only there for 9 months of the year. So we multiply them by 9 divided by 12. That gives us 375,000 shares there. And again, we're trying to figure out the average. Shares issued on October 1st. Again, if you think about it, in October, there's only October, November, December left in the year. So that's only 3 months that these shares are going to be there. So 200,000 shares multiplied by 3 divided by 12 gives us 50,000 shares. And then finally, they had treasury stock. So just remember that treasury stock is repurchasing or taking common stock out of the market, and the company is repurchasing it back for itself. And since it was in December, it's only for 1 month of the year. So we take 10,000. So we take the 120,000 shares, multiply it by 1 out of 12, and that gives us 10,000 treasury shares. So those are going to be deducted from the other shares. So we add up all of these together, and that gives us the weighted average. And again, the weighted average is the total shares that you had throughout the year based on how long you had each amount of shares. So you take the 1 million from the beginning, and then the one from April, and the one from October, and then you subtract the treasury shares from December, and that gives you a weighted average of 1,415,000 shares. And again, this is an easy way to do it. We're going to talk about another way you can calculate the weighted average, but you have to calculate this to know the average basically throughout the year, how many shares on average there were, and then we can take the net income in step 2 and divide it by the weighted average of shares, and that gives you the earnings per share throughout the year of $2.54. So that question was an intro into how to calculate the basic earnings per share. Again, you basically take the net income less preferred dividends. We didn't talk about that in this problem, but that is something you need to remember, divided by the weighted average number of common shares outstanding. And it's not too difficult. You just need to pay attention to the dates and then count how many months from the date that those shares were issued. So you can multiply it by how many months it was there in the year, and that will give you overall the weighted average number of shares when you add it all up together. Let's go to the next question and learn a little bit more and maybe a slightly different way to calculate it. All right, here we are at question 2. Again, let's read the last part of it. What is the weighted average number of common shares outstanding that should be used to calculate basic earnings per share for the year? So for this question, we're specifically focusing on figuring out the weighted average number of common shares. In the end, we don't have to calculate the actual EPS. So let's read through the rest of this. At the beginning of the year, Skyline Corp had 500,000 shares of common stock outstanding. On February 1st, the company declared and completed a 2-for-1 stock split. Okay, so that's something new. On March 1st, Skyline declared and distributed a 10% stock dividend. Again, something new that we haven't seen in the previous question. On May 1st, the company issued 300,000 additional shares of common stock. On September 1st, Skyline Corp issued another 200,000 shares of common stock. Skyline Corp reported net income of $2 million for the year and paid no preferred dividends. Okay, so a lot happened in just 1 year. They started out with a certain amount of shares, then they had a 2-for-1 stock split, and then a 10% stock dividend, and then they still issued more shares. So a lot happened here. Now we need to figure out what the weighted average number of common shares is. You learned how to do this in the previous question. Honestly, I bet, except for maybe the 2-for-1 stock split and the 10% stock dividend, and you could probably figure those out as well, that you could do this calculation. So if you want, go ahead and give it a try. And when you're ready, come back, we'll look at it together. If not, again, we're going to learn how to do this and we're going to go straight to the answer. All right, here we are at the answer. The answer is B, 1,366,667 common shares is what the weighted average common shares is at the end of the year. So let's walk through this. Again, we're dealing with a stock split and a stock dividend and just trying to figure this out. And this is going to be a slightly different way of calculating the weighted average because I wanted to show you 2 different ways to think about it. So let's start. Step 1. We have to adjust for the stock split and the stock dividend. Something that you need to know, stock dividends and stock splits are treated as if they occurred at the beginning of the year, regardless of when they actually happened. So with that information, this stock split, even though it happened February 1st, we take the shares that there were at the beginning of the year and multiply it by 2, giving us 1 million shares, again, as if it had happened at the beginning of the year. Since the stock split happened first, it happened in February compared to the stock dividend in March. This is the thing we calculate first, and then we do the stock dividend, and the stock dividend was 10%, so we take this 1 million shares after the 2-for-1 stock split, multiply it by 1.1, because that will give us the new amount, including the stock dividend. So that gives us 1,100,000 shares, and that's adjusted for the stock dividend. Now, if by chance the stock dividend had happened first, and then the stock split happened, that would be the order you do it in. So in this case, it would be a stock dividend first, which would have been 550,000 shares, and then you would have split it into 2, and 550,000 times 2 is 1,100,000. So in the end, in this case, it ends up being the exact same. But again, that's something important you need to remember. Stock dividends or stock splits, hopefully you won't see them too often mixed together like this, but I just wanted to show you both of them at the same time. They are treated as if they happened at the beginning of the year, specifically when you are trying to figure out the weighted average common shares for the year. So now that we have that, 1,100,000 shares at the beginning of the year, that's what we're considering happened at the beginning of the year. Now we take this 1,100,000 shares. This was the amount for 4 months of the year because it was from January to the very beginning of May. So January, February, March, April, that's 4 months. So we multiply it by 4 out of 12 months, and that gives us 366,667 shares. And then again, this is a different way to calculate it. Then we add 300,000 shares. And for 4 months, that is the new total. So from May to September, so May, June, July, August, that's 4 months. That gives us 1 million. And again, this is based off of adding in the new shares. So 1,400,000 shares for 4 months. So that multiply it by 4 out of 12. That gives us 466,667 shares. And then again, from September to the end of the year. So September, October, November, December, that gives us, we're adding these 200,000 shares. That's how long they were included. So 1,400,000 plus the new 200,000. So 1,600,000 is the total for 4 months, for the last 4 months of the year. So that's 533,333. So then we add up all these different totals, the 366,667 plus the 466,667 and the 533,333. That gives us 1,366,667,000 shares. So again, this is a different way of looking at it. You can either do where, like in the previous question, where you take the beginning amount and just keep that for all 12 months, and then you take the next amount and keep that for the rest of the year, and the next amount and keep that for the rest of the year, and you don't have to add them all up as you go. You just multiply them each by the amount of months that they were available for the year or that they were there for the year. And then there's this approach, which again, you can do either approach, where you take each amount for however many months it was there, and then when new shares are added or subtracted, that's then the new amount for however many months that it's there, and you multiply it by the new amount, by that amount of months. It's a little bit hard to explain, but basically this is another way that you can do it. You can calculate it this way by taking the average number of shares using the portion of the year each set of shares was outstanding. So we're just calculating how much shares there was for each portion of the year. So you can do this approach, or you can do the approach we saw in the previous question. Either way, you're going to be able to calculate the weighted average common shares. And remember, stock splits and stock dividends are counted as if they had occurred at the beginning of the year, and you take them in order that they occurred. Let's go to the next question. All right, here we are at question 3. Again, always read the last part. What is Turner Corp's basic earnings per share for the year 1? Okay, pretty easy. We've kind of been learning about this, so let's read this. They had the following events. Beginning of the year, 600,000 shares. January 1st, issued 150,000 shares of non-convertible preferred stock. Declared dividends, $100,000 dividends for common stock, and they also declared $75,000 dividends on preferred stock. Then they had net income of $500,000 for the year, and then they did not issue any additional common stock. So this one's a little bit different. We have to figure out what the basic earnings per share is. We've talked a little bit about this if you paid attention in the previous 2 questions. Remember the equation for figuring out the income, the net income that's used for this EPS calculation. Think through this. Think through what we've talked about. Pause the video, and when you're done with the calculation, come back and we'll look at it together. All right, here we are at the answer. The answer is A, 71 cents per share. So let's walk through this. For basic earnings per share, preferred stock is not included in the denominator because basic EPS focuses on how much income is available to common shareholders. So this non-convertible preferred stock right there is not included because we're focusing on the common shares. So again, the 150,000 non-convertible preferred stock is not included. Also, dividends on common stock are also not included. So because again, we're just trying to look at how much is available to the common shareholders. So we calculate it here. Net income less preferred dividends divided by the weighted average number of common shares. We've done the weighted average before, but this one's pretty easy because they didn't have any new shares. Net income less the preferred dividends is $425,000 in this case. Common shares outstanding, again, didn't change because those preferred dividends were non-convertible, so they didn't turn into common stock, and there weren't any other distributions. So $425,000 divided by 600,000 shares gives us 0.7083, or really it's 71 cents when you round it up, and that's what you're going to always have to do because you have to round up to have the cent. But that one was a little bit easier, just to remind you and show you that you do need to take into account preferred stock dividends. Now let's go to the next question, and we're going to learn about dilutive EPS. All right, here we are at question 4. Apex Inc. reported the following information for the year ended December 31st. Oh wait, we always got to read the last part. What is Apex's diluted EPS for the year? So we know that we need to calculate the diluted, not the normal basic EPS. They had net income of $900,000, 1 million shares of common stock for the entire year, 40,000 shares of $10 par 6% convertible preferred stock were outstanding throughout the year. Each preferred share is convertible into 3 shares of common stock. Preferred dividends were declared and paid. There are no other potentially dilutive securities. Okay, now we've talked about basic earnings per share. It's pretty straightforward most of the time, but what about dilutive earnings per share? What even is that? If you don't know, that's okay. We're going to go straight to the answer. But if you've seen this before, pause the video, do the calculation yourself, and when you're ready, come back. We'll look at it together. All right, here is the answer. The answer is C, 80 cents. That's the dilutive earnings per share. So let's walk through this. Now, when calculating diluted earnings per share, we account for the potential conversion of the preferred shares into common stock. I just want to say this up front because just to make sure you understand this, dilutive earnings per share is basically things that would have or could have affected earnings per share. They're not necessarily things that did happen. They are the things that if they had happened, they would have diluted the earnings per share. So just keep that in mind. This is if. This is like an if scenario. So something that you should almost always do, maybe not every single situation, but most of the time, it's good to calculate the basic earnings per share, even if you're trying to figure out the diluted earnings per share, because the basic earnings per share will give you an idea of whether something is actually dilutive, because if it's not dilutive, then it's not going to decrease earnings per share. And that would be something important to know. So again, let's do the basic earnings per share first. It'll be pretty easy. We take the net income less the preferred dividends. Remember, they were declared and paid, and the way that we would calculate them in this case is we take that $10 par value, multiply it by that 6% rate, and multiply it by the amount of shares that there were, and that gives you $24,000 of preferred dividends. So we take that out of the net income, divide it by the common shares available, and that gives you a rounded 88 cents for basic earnings per share. Now that's the basic earnings per share. Now let's do the scenario where if they had converted the preferred stock to common stock. For diluted earnings per share, we assume the preferred shares are converted into common stock. This requires two adjustments. The first adjustment is adding back the preferred dividends to the net income, because the company wouldn't have to pay these dividends if the preferred shares were converted to common stock. So you can kind of skip a step sometimes if you think about it with the diluted earnings per share when it comes to convertible preferred shares, because when you convert it from preferred to common stock, you no longer have to pay those preferred dividends, so they no longer are being subtracted from the net income. So the adjusted net income is actually technically just the normal net income of $900,000. So that's $900,000 because they didn't have to subtract the preferred dividends anymore. And then you add the converted shares to the common shares outstanding. That's 40,000 preferred shares multiplied by 3, because remember, it says up here that each of them can be converted into 3 shares of common stock. So that's 120,000 additional common shares. So with this new $120,000 and taking the net income back up to $900,000, that would give us that would be $900,000 divided by 1,120,000 shares now, and that gives us a rounded 80 cents per share, or diluted earnings per share. So we can see that it is a dilutive. It went from 88 cents to, if this had happened, if they had converted the preferred stock it would go down to 80 cents. That is dilutive. The earnings per share went down. It was diluted across more shares. So that's what that means. That's how that works. Diluted earnings per share is basically taking into account things that could make the earnings per share lower. So that was one thing. Convertible preferred shares being converted to common stock, that would be something that would be a dilutive. That would be dilutive. Let's go to the next question to learn a little bit more about something else. All right, here we are at question 5. Let's read the last part. What is Vega Corp's diluted EPS? So similar question. Vega Corp reported the following information for the year ended: net income of $1,200,000, 800,000 shares of common stock were outstanding throughout the year. Vega Corp issued $500,000 of 6% convertible bonds, not convertible preferred shares, at the beginning of the year. Each $1,000 bond is convertible into 40 shares of common stock. The company's tax rate is 30%. No other potentially dilutive securities are outstanding. Okay, so again, this is something that if it was converted from a bond to common shares, it would dilute the company's EPS. So this is different than the previous question. If you have an idea how to do this, that's great. Pause the video. If not, we're going to dive straight into the answer to learn how to do this. All right, here we are at the answer. The answer is B. $1.49 is the dilutive earnings per share. Now, this question is quite involved. It looks worse than it is. So let's walk through it. We're going to read a lot. To calculate diluted earnings per share, we have to take into account that potential conversion of the bonds into common stock. So that's what we're doing here. So let's go down here to step 1. We have to calculate the basic earnings per share. Again, the reason that you do this, you don't always have to do this, especially with the CPA exam. A lot of times you're probably able to just dive straight into the dilutive earnings per share, but it is a good idea, especially for like a sim that was about something like this, to know the basic earnings per share, because then you can know if something is actually dilutive or not. Because based off of the earnings per share of $1.50, if the dilutive earnings per share was actually greater than $1.50, it's actually not dilutive. So, and we're going to talk about that in the next question, by the way. But with this one, We know that the basic earnings per share is $1.50 because of the net income and the common shares outstanding. Now let's do the adjustment for the convertible bonds. So when it comes to convertible bonds being converted to common stock, there's two things you need to take into account. And this is one of them, and this is one of them right here. So first we have to add back the after-tax interest expense. Normally, the interest paid on the convertible bonds is deducted from net income because it's an expense for the company. So they are able to deduct this interest expense, and that's good for taxes. However, if the bonds were converted into common stock, the company would no longer be paying that interest, so we add back the interest expense to the net income. But there's a catch. Interest expense, again, is tax deductible. This means that the company reduces taxable income by the amount of interest it pays, which lowers its tax liability. When we add back the interest expense for diluted EPS, we only add back the after-tax portion of the interest because the company loses the tax deduction it would have received. So there's two things happening right there at the same time. They're no longer having to pay that interest to the people who had the bonds, so it's added back to net income, but they were able to deduct that interest expense for taxes previously. Since they're no longer able to deduct that, you have to take in the tax into account, and so the actual amount of interest expense that can be added back to net income is the after-tax interest expense. So here, you would take the interest expense of $500,000, multiply it by the 6% interest rate, $30,000. The tax savings on that, based off of that 30% tax rate at the beginning of the question, 30,000 multiplied by 30% is 9,000. So that's the tax savings that they originally had. So we take that out of the interest expense, and that gives us the $21,000 of interest expense that we get to add back to the net income because they didn't have to pay that anymore. We add that back. That gives us a new adjusted net income of $1,221,000. Now that we know that, we can go down here a little bit further to finally finish up the question. So we have this new net income, and then we figure out the bonds. The number of bonds is $500,000 divided by $1,000 per bond, because it said that each bond was worth $1,000. So that means there's 500 bonds. Each bond can be converted into 40 shares, like it said at the beginning of the question. 500 times 40 shares is 20,000 new shares if they're converted to common stock. So with this new amount of shares and this new net income, we go down here to using this new net income and taking the original 800,000 shares, adding the 20,000 shares from the bond conversion, and that gives us $1,221,000 divided by 820,000 shares, and that gives us a new EPS, or a diluted EPS, $1.48.9, or really just $1.49 when you round it. So it's not too different. If we scroll back up here a little bit, the original basic was $1.50. Now it's $1.49. So it diluted a teeny bit, but it did dilute. So that means that this was an actually dilutive event that if it had happened, it would have diluted the earnings per share. So again, a little bit involved. Not too bad once you've gone through it, hopefully. Now let's go to the next question to learn a little bit more. All right, here we are at question 6. Let's always read the last part here. What is the difference between Olympus Corp's basic earnings per share and diluted earnings per share for the year? Okay, so this is going to be a question where it is important to calculate both the basic and the diluted earnings per share. Let's read through this. Olympus Corp reported a net income of $750,000 for the year ended. The company had 500,000 shares of common stock outstanding throughout the year. On July 1st, they issued an additional 100,000 shares. During the year, the company also granted incentive stock options to key employees, allowing them to purchase 50,000 shares of common stock at exercise price of $20 per share. The average market price of Olympus's common stock during the year was $15 per share. There are no other potentially dilutive securities. Okay, so a lot of information there. We need to figure out the basic earnings per share and then the diluted earnings per share to see what the difference is there. Now, we've gone through a lot of this before. The only thing that's new here is these incentive stock options. Think about it. Come back when you're ready if you want to have a guess, and try to calculate it yourself, and we'll look at it together when you're ready. All right, here we are at the answer. The answer is actually D, $0. There is no difference between the diluted and the basic earnings per share. Let's learn why. To calculate the difference between the basic earnings per share and the diluted earnings per share, we need to check whether the stock options are dilutive or anti-dilutive. Remember, we talked about that a little bit in one of the previous questions. So first we have to figure out the basic earnings per share. We take the net income, take the common shares outstanding at the start of the year, which was 500,000 shares, take the new 100,000 shares issued on July 1st, Since they were issued on July 1st, they're only weighted as 6 out of 12 months. So 500,000 plus the 100,000 multiplied by 6 out of 12 gives us 550,000 shares. So that's the weighted average common shares, 550,000 shares. And so we divide $750,000 of net income by the 550,000 shares. And that gives us a rounded $1.36 of basic earnings per share. Now, we know the basic earnings per share. Now we can figure out if there's a difference for the diluted earnings per share. We have to check for dilution. And again, this is something you might have to do in like a sim or something like that. So don't get caught up in thinking it is always dilutive. We have to consider these incentive stock options. For stock options, to dilute EPS, the exercise price from the options must be lower than the average market price of the stock. The option price here is $20 per share. The average market price is $15 per share. So in this case, since the option price is higher than the market price, the stock options are anti-dilutive. This means the options would not reduce EPS, but instead would increase it. Because if the option price is higher than the average market price, that is going to raise earnings per share, and that's not dilutive, that's anti-dilutive. We're only concerned with potentially dilutive events. Since this is not going to dilute, but it's actually going to increase, or it's anti-dilutive, we don't take it into consideration when we're considering dilutive earnings per share. So if we're not looking at that, we go down here. Since those stock options are anti-dilutive, we don't include them. So there's no dilution event or effect. So the diluted earnings per share is actually the same because there was nothing that actually diluted the earnings per share. So basic earnings per share and diluted earnings per share are both $1.36. So there's no difference. It's a $0 difference. So that's something to keep in mind, is that if something actually increases earnings per share, it is not dilutive. Don't get confused by that. It's anti-dilutive, and you don't include it in the dilutive calculation. With all that, we've learned a lot in just 6 questions. I know some of it might have been a little bit confusing, so before we go any further, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is, as you're going through the questions, you will notice and you will learn the formulas, the topics, the equations that keep popping up that they're trying to teach you in multiple questions. So you know they're important. You know this is what I need to know for the exam based off of what I learned from the questions. So you write it down kind of as a summary of the key topics, the pillar topics from what you learned from the questions. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight into it. First off, basic earnings per share is calculated using the formula net income less preferred dividends, all divided by the weighted average common shares outstanding. It's actually the same for diluted earnings per share, like you use the same equation, but you have to take into account any securities that could convert into common stock, and that would potentially dilute earnings per share. Let's talk about each of the things that we learned in this video. Preferred stock dividends. Preferred stock dividends are subtracted from net income in basic earnings per share calculations because preferred shareholders get paid before common shareholders. Stock dividends and stock splits. Stock dividends increase the number of shares outstanding but don't affect the company's value. They are accounted for as if they occurred at the beginning of the year. And then for stock splits, these increase the number of shares while decreasing the price per share, with splits treated as occurring at the start of the year. So both of these are treated as if they retroactively started at the beginning of the year, specifically when you're trying to calculate earnings per share and you trying to figure out the weighted average common shares outstanding. Now let's talk about convertible preferred stock. Convertible preferred stock is treated as if it's converted into common stock when calculating diluted EPS, meaning preferred dividends are added back to net income. So we talked about that up here. Preferred stock dividends for normal basic EPS, they're taken out of the net income. But if you are thinking about converting the preferred stock, like if you're talking about that potential, those would be added back to the net income, and the new common shares are added to the denominator, and that's going to potentially dilute your EPS. Next, the convertible bonds. When calculating diluted EPS, the after-tax interest expense from convertible bonds is added back to net income because the company no longer has to pay interest after conversion. Additional shares from the bond conversion are added to the common shares outstanding. Don't forget that this is the after-tax interest expense, so you need to take into consideration the taxes that the tax savings that they're losing out on by paying this interest. And then finally, just a simple rule here, a security or whatever the case may be is anti-dilutive if its conversion or exercise would increase EPS rather than decrease it. So if something that could potentially happen actually would increase earnings per share, it's not dilutive, it's anti-dilutive, and you would not include it in the dilutive earnings per share calculation. Now I know, again, we went over a lot in this video in just 6 questions. Remember that if you are a Superfast CPA member, you can access the full 12-question video on SuperfastCPA.com. So if you liked this and you found this helpful, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com to see if you think that our strategies are helpful and to potentially become a member of Superfast CPA, because you can get more videos and more question practice like this. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next